and will generate huge demand, such as we haven't seen in the West, for these base metals. That's why China is hanging on to her silver, for goodness sake. I mean, and her rare earths, and even things like antimony, which is also part of this new licensing regime. So we're going to see these base metals rising in price, and this is going to be the big, big surprise, I think, in 2026. And not only that, but the declining purchasing power of the dollar means that consumer prices will also be rising quite sharply on their own volition. Inflation is going to be the big story. Well, it's an interesting situation. I mean, silver has been suppressed by China in terms of price for years. The Silver Institute reckons that it's been in supply deficit for the last 5 or 6 years. And the only thing that makes up the difference is something called investment. So you've got investors, if you like, supplying the silver. Now, within that investment total, I don't think there's an awful lot in terms of genuine investment, but what there is stockpiles. And this particularly includes China. And what China has been doing is that when there is industrial demand around the world, it has been prepared to act as the swing factor to keep the prices suppressed. And that way, of course, the silver institutes, the calculations then run into balance. China has stopped doing that. And I think there are a combination of factors as to, behind it. I think, first of all, President Trump's wonderful tariffs and his attack on China has woken China up to the fact that, you can't deal with this guy. And, the whole of the rare earth thing, which they've got control over, that's the one thing they've got, they've got the West, if you like, in their grasp there. And I think the other thing, as far as China is concerned, is that they can see that demand for silver is now going off the charts, and they're not willing to supply it anymore. The reason it's going off the charts is because India is becoming a major force in terms of silver demand. The Indian economy, I reckon, is roughly where China was about 25, 30 years ago. It is dynamic. It is expanding very rapidly in terms of its productive capacity. And because it has been opening, sort of coal-fired energy stations in big numbers, it's sort of trying to go carbon neutral by 2035. And the way it's doing that is that the government is subsidizing and encouraging major conglomerates in India to manufacture photovoltaic cells. So you have the situation where Reliance Industries, for example, is producing the most enormous quantity of photovoltaic cells. They're generating electricity out of these things, and they are demanding huge quantities of silver. And where do they go for it? Well, they have to go into the market. So you can see that you've got this squeeze happening.
The epicenter of silver demand is shifting east. India's rapid industrial expansion, particularly in solar energy and advanced manufacturing, is driving unprecedented consumption. Government-backed photovoltaic programs require vast amounts of silver, and production is accelerating. At the same time, scrap supply is not responding as expected. Households are choosing to hold silver rather than exchange it for weakening local currencies. This behavior tightens availability further. Meanwhile, major producing nations are prioritizing domestic needs over exports. Together, these forces create a synchronized squeeze, demand rising sharply, supply becoming less flexible, and inventories no longer acting as shock absorbers.
It so happens that China is now in the position where for years 26 and 27, she is introducing a new export licensing regime with the explicit purpose of protecting China's own domestic supplies of silver. So this shortage is now showing up in the markets big time. I saw one of, a fellow Substacker who is very, very close to the LBMA, has got all the figures and all the rest of it to a greater extent than I have, tweeted this morning, or set a Substack out this morning, to the effect that the lease rate in London is back up at 6-7%. The shortage is still there. So what we're seeing is an industry-driven re-rating. And the fascinating thing is that speculator interest or investor interest in the West is minimal. I mean, what's been happening on COMEX is that the open interest in silver has generally been declining. Now, I think there is a bit more, if you like, public interest in silver in Asia, because the Asians, I think, have a greater feeling that silver is a monetary metal and therefore is better than fiat currency. But this hasn't started here yet. And I can see that, with the price soaring today, I mean, as we talk, we're just under $64. People are going to be sitting there on their hands thinking, my goodness, we're missing out on this. What do we do? And, they'll probably try and pile in a market where there is no silver. And it's leading, in my view, to the destruction of the paper silver market. I mean, this is basically what we're seeing, I think, with open interest declining. The shorts don't want to be short anymore. And if the shorts aren't going to be short, then, the quantity declines. And that's really what we're seeing. And as to where it stops, I mean, the squeezes in commodities, are a lot more vicious than any squeeze you see in an investment category like stocks or, currencies or bonds or whatever. I mean, you do occasionally get a real sort of squeeze in an individual stock. But in commodities, I mean, this can take a commodity up 3 or 4 times over the period of a quarter or two. And I think we're seeing something like that happening in silver.
Market stress is now visible in places most investors overlook. Lease rates in key trading hubs have surged, signaling difficulty sourcing physical metal. Open interest in futures markets is falling, not because demand is gone, but because participants are increasingly unwilling to remain short. This erosion of paper market confidence suggests a deeper problem. Financial claims are losing credibility without reliable physical backing. As liquidity thins, price discovery becomes unstable. Historically, when commodities enter this phase, price moves accelerate violently. The silver market is beginning to resemble previous breakdowns, where paper structures failed under real-world supply constraints.
Well, the tens, you get a tendency for everybody to be the same way. I mean, in stocks, that doesn't really happen. You've always got sellers in a rising market in stocks, so that there is liquidity, if you like. So what you get is that when the price rises, it just creates liquidity, which, of course, is the standard textbook relationship between supply and demand is reflected in the price. But in commodities, it's very, very different, because when a commodity really starts moving, all the industrial users tend to be in the same in the same situation, and the supply is relatively inflexible. I mean, you've got mine supply, and that's more or less it. You might have some scrap supply. Now, this is interesting, because in India, scrap supply, you'd think that on a rising price like this, there would be scrap supply, but no, there isn't. Why? Because the Indian population collectively appear to be taking the view that they'd rather hang on to their scrap silver than sell it for rupees. And I think you needn't look any further. I think the other thing is that when you get all commodities tending to move in the same direction, we talk about base metals a bit, which is what's happening. That tends to reflect a debasement of the currency in which you're measuring these things. So that is another factor which is behind this. It is certainly behind gold. Silver has this sort of industrial demand factor in addition. But if you look at the price of base metals, a basket of base metals priced in gold, very recently it's been at the lowest level ever. Like something like less than 20%. I think something like got down to about 17% of the 1900, like 125 years ago, value. And this has been, this sell-off has been really over the last 10 years or so. I mean, it really has absolutely collapsed in terms of gold. Now, the obvious story there is that, well, it reflects the gold price rising. The second thing is, who cares about pricing these things in gold? But that shows an ignorance of really what gold is. Gold is stable money. It is money without counterparty risk. It is money which credit used to refer to. And now that credit isn't referring to gold, it is credit that is declining. And it's messing up quite a lot of relationships on the way. Now, if you accept that gold, and history will prove this, that gold has relatively constant purchasing power over periods of time, then to see the value of a basket of base metals at under 20% of where they were in 1900, and for a long time, while there was a gold standard, then you will understand that that basket of base metals is going to rise. I'm not saying when, but now seems quite likely. It is going to rise, measured in gold, by a factor maybe of 4 or 5 times in order to get back to that normal level. And if at the same time the purchasing power of dollars, euros, whatever declines, then you can see that there is a massive bull market potential measured in depreciating dollars for a basket of base metals. And indeed, we're seeing copper has been moving up quite happily. Now, here's the West on the basis it's looking like the economies are stagnating and so on. If you look at the Fed's beige book, you certainly get this view. If you go around the country, you'll see that it's actually very, very tough for the medium and smaller businesses, all that sort of stuff. So you would think that there wouldn't be the demand for these metals. So why should they be rising? Well, there's a twofold answer to that. That is, the obvious one is that the purchasing power of the currency you're measuring it is going down. And the second thing is that there's a whole world there being run by China and to a lesser extent Russia, which takes in about 70% of the world's population, which is rapidly industrializing and will generate huge demand, such as we haven't seen in the West, for these base metals. That's why China is hanging on to her silver, for goodness sake. And her rare earths, and even things like antimony, which is also part of this new licensing regime. So we're going to see these base metals rising in price, and this is going to be the big, big surprise, I think, in 2026. And not only that, but the declining purchasing power of the dollar means that consumer prices will also be rising quite sharply on their own volition. Inflation is going to be the big story. Forget what the Fed says. Inflation is going to be the big, big killer in 26 and into 27.
Silver's story does not stand alone. A broad basket of industrial metals, when measured against gold, has fallen to historically extreme lows, levels unseen in over a century. This is not a collapse in utility or demand. It reflects currency degradation. Gold, acting as stable money, exposes how far fiat purchasing power has eroded. When metals priced in gold reach such depressed levels, history suggests reversion is inevitable. That adjustment can occur through higher metal prices, weaker currencies, or both. Current conditions strongly imply both forces may act simultaneously.
Yeah, the underlying problem, I think, is that fiat currencies have a limited lifespan. And we're coming to the end of that era. 54 years since 1971, August 71, when the fiat currency era, if you like, really started. It had been moving that way for some time before. If you look at it purely in terms of the running down of US Treasury gold stocks, that is something that was declining from about 1950 onwards. So they maintained the link with gold at $35, basically by selling gold into the market to underpin the value of the dollar. And by 1971, they could no longer do that. It was quite clear that demand was mounting, having had the gold pool failure in the late 1960s, etc., etc. The thing about fiat currencies is that it removes the necessity for government responsibility towards debt, control of its own spending, and so on. It allows politicians to borrow without consequence, without apparent consequence. But of course, the consequence is the depreciation of the currency. And we've seen that. I mean, if you go from $35 to the current level of $4,275 as we speak, then that is a depreciation of the dollar. There's no two ways about it. And the thing that leads to the end of a fiat currency era is basically its debasement. And its debasement comes in the form of excess debt. And it's the deployment of debt unproductively. There's nothing wrong with credit so long as it is deployed productively. But no, we get credit being produced by banks and also abetted by the central bank, maybe driven even by the central bank, to support consumption, which is inflationary. Governments tax savings, which basically makes savings unattractive. Not only unattractive from the point of view of you get taxed on savings. If you leave money in deposit or whatever and you're paid interest, that sort of thing. But also from the point of view that everybody knows that the purchasing power of your currency tomorrow is going to be less than today. So why save? Just spend. So that again is destructive. And more recently, what we have seen, and this is really the case, I think, since about the year 2000 or 2002, when Greenspan was Fed chairman, we have seen the deployment of credit to buoy up financial assets. And that leads to a bubble. And the bubble eventually goes pop. And then what happens? Well, we can see, we can imagine what happens. The Fed has started doing QE again. And when the bubble goes pop, you'll find that banks will be liquidating loans by selling collateral, which is what the stock is. And the selling pressure will be made even worse by foreigners who own over 20 trillion of US equities. And the Fed will be in there trying to support the whole caboodle. And just think about the amount of QE that would be required to do that and keep the banking system from going under, to keep the whole derivative system from going under, which incidentally Silver is sort of suggesting is a risk.
Despite economic slowdown narratives in the West, commodity prices are rising. This paradox resolves once currency dilution is acknowledged. A majority of the global population lives in economies still industrializing at scale, demanding raw materials relentlessly. Meanwhile, years of debt-fueled stimulus have weakened monetary foundations. Inflation is unlikely to fade. It is poised to reaccelerate. As confidence in financial assets wavers, capital historically migrates toward tangible value. Silver, sitting at the intersection of industrial necessity and monetary refuge, becomes uniquely positioned during such transitions.
This is no light touch job. The QE is going to have to be massive. The other side of that, of course, is that it destroys the value of the currency. There's no two ways about it. And this is what gold has been signaling. This is why gold in the recent months, in the second half of this year, has soared to levels which have surprised everybody. Gold is telling us that this is the danger. And as the danger gets more and more real, gold goes even higher. It's front-running, if you like, the collapse of the dollar. And you get the collapse of the dollar, it takes all the other currencies with it, because they all refer one way or the other to the dollar. So that's where we are. And this is why if you look at prices generally, there's going to be a huge, huge supply in 26, 27. This situation is very, very similar to the situation in late 1921 in Germany. You had a stock market which had tripled. It then crashed on December the 1st. But before that crashed, the Reichsmark price of gold started rising very, very steeply. What have we got now? We've got exactly the same situation. I mean, everybody sort of reckons that, the politicians, if you like, in Germany were horribly irresponsible. The situation was a special situation because the French walked into the Ruhr and you had all these horrid reparations and all the rest of it. Yeah, sure, they had problems. But the key to understanding it is that the politicians had no option but to destroy the currency. And Helfrich, who was finance minister, presided over this. He knew what was happening. And not only that, but this was the man who devised the way out of the currency collapse, which was then overseen. I mean, the recovery was overseen by Schacht. So, these guys knew what they were doing, but they were absolutely powerless to stop it. Do we see today that today's politicians will be able to stop it? I don't think they even understand what the hell they're doing, let alone know what they're doing, understand that they've got no option but to destroy the thing. They're destroying the thing from a position of complete and utter ignorance. That is today's reality. You've also got the entire macroeconomic community who do not understand economics. They do not understand money, and they do not understand credit, and they don't understand the difference between the two. Now, that's something which should frighten everybody. There's got to be a complete education process before they can really grasp the nettle of dealing with this. So my working assumption is that the dollar's value will go down to zero. Unless something comes in, unless there's some politician, if you like, and it won't be Trump, that is for sure, gets the mandate, over some window, moves so that he's got the mandate from the public actually to deal with the situation. And it assumes that he actually understands what the problem is. Basically, what they've got to do is they've got to get themselves back on a gold standard. They've got to cut public spending. They have got to allow businesses which should go bust to go bust. I just don't see we're anywhere near that. Nowhere near that. And I really can't see the conditions whereby that would actually happen.
Fiat systems have limits, and history shows how they end, through excess debt, political paralysis, and currency debasement. Once governments rely on perpetual monetary expansion to stabilize markets, purchasing power erosion accelerates. Gold has already begun signaling this risk by reaching new highs. Silver often follows later, but faster. Past monetary breakdowns reveal a familiar pattern. Asset bubbles peak, currencies weaken, and real assets reprice abruptly. Without structural reform, the trajectory becomes difficult to reverse. In that context, silver's behavior may not be speculative excess, but an early warning of systemic change.